Welcome to the Skilled MBA Finance Case Study Series, where strategic finance meets real-world challenges. In the heart of Mumbai's tech ecosystem, MotoSpin, a growing marketplace startup, is facing a tough Series B funding round at a downward valuation. GoStage Ventures, a key stakeholder, must now decide, should they accept the down round despite aggressive terms? Can they renegotiate for better conditions? Or is it time to explore alternative financing paths? This decision has far-reaching consequences for MotoSpin's survival, control structure, investor confidence, and long-term equity value. The case offers an in-depth look into venture capital dynamics, stakeholder alignment, and managing financial risk in high-growth startups. MotoSpin, a tech marketplace in Mumbai, is navigating a tough Series B funding round with a lower valuation. GoStage Ventures faces a critical decision: accept a down round with tough terms, renegotiate, or explore alternatives. This choice affects survival, control, market perception, and long-term equity value for all stakeholders. MotoSpin, a Mumbai-based marketplace, connects buyers and sellers of motorcycles, scooters, and electric vehicles, and is currently seeking Series B funding. GoStage Ventures, a global venture capital firm led by Vice President Atish King, holds a significant stake in MotoSpin, playing a crucial role in the funding decision process. The 2024 funding environment for Indian startups is challenging, with a 70% decline in available venture capital. Series B startups face a 60% likelihood of accepting lower valuations. Investor caution is evident, with 85% of investors increasing due diligence and imposing tougher term sheets on growth stage companies. One Capital, a United States-based impact fund, focuses on sustainable transportation with aggressive down-round terms. The valuation drops 50% from 400 crore rupees to 200 crore rupees with 50 crore rupees funding. Control shifts as One Capital gains 2 board seats and veto rights. Aggressive terms include a 2x liquidation preference and full ratchet anti-dilution protection. Down rounds occur when a company raises capital at a lower valuation than previous rounds, leading to significant equity dilution for founders and existing investors. This can signal a struggling business, impacting relationships with partners, customers, and employees. Such rounds often include investor-friendly terms, shifting control and financial benefits towards new investors. Liquidation preference ensures One Capital receives a 2x return before others in an exit. Anti-dilution protection, specifically full ratchet, grants more shares if future valuations drop. Board control shifts governance, giving the new investor significant influence over company decisions. These terms heavily impact existing stakeholders, altering financial and strategic dynamics. GoStage Ventures faces a strategic dilemma. Accepting a down round secures funding, but results in significant dilution and loss of control. Renegotiating terms offers better protection, but risks losing the offer. Seeking alternatives might yield better terms, but risks MotoSpin running out of cash. Each option balances immediate survival against long-term equity value. The down round significantly alters the cap table. Founders' equity drops from 40% to 24%, while GoStage Ventures' stake decreases from 30% to 18%. Other Series A investors see their share reduced from 20% to 12%. The employee stock option pool shrinks from 10% to 6%. One Capital gains a 40% stake, becoming a major shareholder. In the current market, securing investor-friendly terms often outweighs maintaining a high valuation. GoStage can protect existing investors by negotiating terms that balance interests, such as moderating liquidation preferences. Maintaining a positive relationship with MotoSpin's founders is crucial, as is employing strategies to mitigate negative market perceptions of a down round. Moderating the liquidation preference to 1.5x can balance investor returns while protecting equity. Replacing full ratchet with weighted average anti-dilution minimizes dilution impact. Maintaining board composition with an observer seat for one capital ensures strategic alignment. Milestone-based vesting for investor rights aligns interests and mitigates risks. Strategic negotiation hinges on understanding each party's priorities. Down rounds impact cap tables by reducing valuations, leading to increased founder dilution and altered ownership structures. Key term sheet negotiations involve liquidation preferences, pay-to-play, and anti-dilution clauses. Strategic decision-making requires balancing immediate capital needs with long-term equity value. Early funding decisions shape future investor relationships and influence subsequent funding rounds. Market timing is crucial. Knowing when to raise capital versus optimizing runway through cost-cutting can significantly impact a company's trajectory. Aligning with investors whose strategic objectives match the company's vision is essential beyond just valuation. Developing term sheet literacy is vital for understanding the long-term implications of early-stage funding terms, ensuring informed decision-making. Evaluate Motospin's cash runway to determine financial urgency. Assess One Capital's strategic value beyond funding, considering potential synergies. Analyze alternative options for better terms, weighing probabilities. Consider long-term impacts on future funding rounds and exit strategies. A structured decision framework ensures comprehensive evaluation of these critical factors before making pivotal decisions. Thank you for joining us. Continue your journey with Skilled Master of Business Administration to enhance your skills and leadership. Mobile +91-87 553-00795. Email support@skilledmba.com. Website www.skilledmba.com.